Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Cameco.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're looking at a company that's really, it's moved beyond just being a commodity producer.
Right. It feels like it's now positioned at this intersection of global energy infrastructure and, well, the whole clean energy transition.
Exactly.
Okay, so let's unpack that, starting with the financial picture, because the numbers are, they're pretty robust.
You really are.
We're talking about massive revenue growth. I mean, the Q3 2024 trailing 12-month, the TTM revenue hit CAD 7.3 billion.
Yeah, and for anyone listening, that TTM number just gives a much clearer picture of momentum than looking at one single quarter.
And it's a significant number. What's encouraging to me is the quality of that growth. It's not just, a reflection of rising nuclear demand.
No, it's also internal efficiency. The profit margins in the uranium business have expanded pretty considerably. They're sitting in the 15 to 20% range now.
So why are they expanding so effectively? Is it just high prices, or is there an operational story here that maybe the market is missing?
Oh, it is absolutely operational. You really have to focus on what's happening at their core assets.
Okay.
The restart at McArthur River, in particular, has just exceeded all expectations. They're bringing this really high-grade material back online so efficiently.
So higher output for a lower cost, basically.
Exactly. That kind of efficiency is what drives long-term profitability, not just riding a spot market wave.
And that sets up a really powerful forward outlook. Analysts are already projecting, 7.69% year-over-year earnings growth for the next disclosure?
That's right. And what's even better is that guidance revisions are trending upward. That tells you management feels very confident.
This is where we have to introduce the friction point in the whole thesis, isn't it? The valuation.
Yeah. The valuation, if you look at the forward PE ratio, it's sitting extremely high at 96.51.
Wait a minute. A PE of 96.51. I mean, in almost any other industry, paying nearly 100 times future earnings would just flag this as pure speculation.
It's a completely fair challenge.
So how do you defend a multiple that high? Are we just paying for potential that might not even materialize?
Okay, the defense really hinges on two things: scarcity and strategy. First, the growth isn't speculative. It's being locked in. They have long-term contracts for 70% of their output.
At prices above spot level.
Significantly above spot.
Yeah.
So that secures revenue years out and just fundamentally reduces risk.
And the second point?
The market is no longer pricing them as a pure miner. It's pricing them as a crucial energy infrastructure play. And those just command higher multiples.
Okay, I appreciate that distinction. But when you're paying that kind of premium, you need rock-solid fundamentals.
I may have them. The balance sheet is incredibly strong. A net cash position of CAD 1.2 billion as of Q3 2024.
And the debt to equity is, under 0.2?
Super low. It gives them unparalleled financial flexibility.
And that flexibility is what's fueling this whole transformation.
It is. I mean, look at the free cash flow, the FCF.
Yeah.
PTM FCF reached CAD 800 million. That's the purest measure of financial health.
And they're allocating that cash pretty intelligently.
They are. I mean, yes, they double the annual dividend to $0.24 a share, which is great for shareholders.
But the majority is going toward the Westinghouse integration.
And that integration is the real key here. It's what changes the whole competitive moat for the company.
It really moves them from just a mining giant to something much more complex and sticky in the global supply chain.
Exactly. The competitive moat is now this vertically integrated model. Before, they controlled about 18% of global uranium production. Now
they control production, plus fuel services, plus reactor tech through Westinghouse.
they own the resource and the downstream service.
Which creates these serious defensive advantages. I mean,
Yeah.
if you're a major utility, the cost and complexity of switching suppliers becomes just enormous.
It locks customers in. It protects market share from smaller competitors who just, sell the raw commodity.
And you can't forget the quality of the assets themselves. McArthur River isn't just a mine.
No, it is universally seen as a Tier 1 asset. It's the world's highest-grade uranium mine. It's like finding a $50 bill when everyone else is scraping for pennies.
So you combine that with the savvy contracting strategy.
And that buffers them against the volatility that just crushes pure exploration companies.
So if we reframe the entire investment thesis, the core story has just completely moved. This isn't a cyclical miner anymore.
Not at all. It's positioning itself as a global energy infrastructure leader.
And the timing for that pivot couldn't be better with the demand shift we're seeing from technology.
Precisely. We are talking about the massive structural tailwinds from AI and data centers. This isn't a buzzword.
No, it's a fundamental requirement. These data centers need reliable, 247 baseload power.
Solar and wind are intermittent. Nuclear is the cleanest, most reliable answer for that kind of continuous power.
That really grounds the thesis. It makes that high PE suddenly look less like speculation and more like an entry point into a multi-decade infrastructure play.
It's a very modern argument for an essential commodity provider.
So if that's the long-term story, how has this shift played out on the charts? Did we see any key technical levels broken?
Absolutely. The stock's been in a very clear pattern of higher highs and higher lows. That confirms the bullish trend.
And there was that breakout above the $50 resistance level, right?
A significant breakout, yeah. That signals strength to technical traders. And crucially, that $45 level has held up as a really key technical support line to watch.
Okay, and what about the broader momentum indicators? Is the picture still constructive there?
Very much so. It's trading comfortably above both the 50-day and the 200-day moving averages.
So that sets up a potential golden cross.
It does, which technical analysts see as confirmation of a long-term uptrend.
Mm.
And importantly, the RSI, the Relative Strength Index, shows it's not in overbought territory.
So there's still room for capital to rotate in?
Plenty room without facing that immediate selling pressure.
And it seems like institutional investors are buying into this longer-term narrative. Ownership stability is high, around 70%.
And we've seen some clear cluster buying activity. Gemmer Asset, for example, added nearly $1 million worth of shares.
Right, and exchange-traded concepts increased their stake massively to over $52 million.
That kind of cluster buying is critical. It shows that institutional capital is committing serious money here. They're not just dipping a toe in.
They're betting on the Westinghouse integration and that AI tailwind.
They are, and that stable inflow helps offset the occasional smaller institutional trim, like the sale we saw from Drummond.
So that net institutional confidence feeds right into the market mood, which I'd say is predominantly bullish right now.
It is. It's that combination of structural demand growth and supply scarcity. It creates a powerful narrative.
So knowing all that, what should we be watching for on the calendar over the next 3 months? What are the key catalysts?
A few major items. On earnings, Q4 2024 results are expected in late February 2026. Given the pricing they've secured, consensus suggests there's a real potential for beats.
Which could trigger the next leg up.
Could, yes.
Yeah.
And beyond the numbers, are there any key events?
Yes. Mark your calendar for January 7, 2026. The COO, Grant Isaac, is doing a fireside chat at Goldman Sachs.
And we'd expect that to focus heavily on the energy transition.
For sure. The role of nuclear, and critically, how the Westinghouse integration is speeding up their whole plan. Any updates on synergies there will be watched very closely.
And the macro environment is just incredibly favorable.
Absolutely. That persistent uranium supply squeeze is a huge tailwind. And if the Fed starts cutting rates, history suggests capital will rotate into hard assets and commodities. That's another macro boost. What about speculative items? There's always market chatter.
Yeah, we've heard some unconfirmed talk about M&A synergies with Westinghouse, maybe opportunities that haven't been priced in yet.
So that's just noise to monitor for now.
For now, yeah. Monitor that alongside any production guidance updates.
Okay, so now we have to turn to the other side of the coin. The bear case. The risks.
We have to. No investment comes without risk, especially one priced for perfection. A top concern is execution risk.
The risk of an earnings miss.
Exactly. We saw a note that the most recent quarter slightly underperformed expectations, so they're not immune to operational bumps.
And we absolutely cannot ignore that 96.51 forward PE. That high valuation is inherently tied to volatility.
It's a huge premium to maintain. If the growth story stutters even slightly, or if the Westinghouse integration proved more difficult, the market correction could be swift and severe.
And that leads back to institutional confidence. We saw the cluster buying, but we also saw that trim from Drummond.
Right. An 82,000 share sale reminds us that not everyone agrees on the entry point. They might be concerned about that valuation.
So you have the dual risks, volatility from the multiple, and the underlying sector risk.
Correct. The core sector cyclicality is still there. But I have to reiterate, the company's done a remarkable job mitigating this.
Not the long-term contracts.
Those locked-in contracts and the recurring revenue from Westinghouse provide a really stable cushion against pure commodity price swings. It makes them far more resilient.
So if we pull all of this together, the assets, the FCF, the strategic shift, what's the overall investment pitch you land on?
I think the pitch is that this company is transitioning from a high-risk miner into a defensive growth play anchored in global infrastructure.
Capturing multi-year demand through those top-tier assets and locked-in contracts.
Exactly. The pivot to being an energy infrastructure leader, servicing the whole nuclear cycle, really differentiates them.
So this isn't about a quick trade. Given the scale of the AI demand, what's the target horizon you'd suggest?
I think this has to be viewed as a multi-year hold. You're aligning with the expected 2028 nuclear build-out timeline. You're not buying a short-term trend, you're investing in a decades-long energy transition.
That's a great summary. It lays out the upside drivers but gives us that necessary dose of skepticism on the valuation. And to all our listeners, please remember to subscribe and like the video so you don't miss our next analysis.